Hey, if you're looking for a gold fund which not only provides exposure to the gold prices or to the gold producers or gold miners, plus if the fund also gives you the regular payouts or weekly distributions, how nice would that be? So this video is all about that. We have this ETF named GDXW, which is a fund which invests in gold miners and also attempts to provide weekly distributions. So that's a great combination, of the asset class plus the investing strategy. Now, this fund is not totally new. It has been in the market for about 10 months. And this is called the Roundhill Gold Miners Weekly Pay ETF. There was another similar fund which I covered in Harvesting Income channel before. That fund name was GLDW. I'm going to show you on the screen. It is called the Gold Weekly Pay ETF. This fund is purely based on the gold prices. So if you are interested in this, you can go back and watch my previous video on GLDW. But the one we are focusing on today is a little different. This is the GDXW, which is the Gold Miners Weekly Pay ETF. So I just wanted to bring out this difference because some people have a confusion about the different ETF names. So let's get started. Um, Before we go ahead, I wanted to just remind you that this video is purely for educational purpose, not investment advice. So with that, let's get quickly started with the basics of the fund, the profile. The ticker symbol is GDXW, as you already know, and Roundhill Gold Miners Weekly Pay ETF is the name of the fund. The fund was started basically in October 2025, like about 10 months now, and they have assets under management about $61 million. And this fund basically tracks the performance of a gold index ETF. That is the VanEck Gold Miners ETF that you see on the screen. And that ETF in turn tracks the returns of the market vector gold miners index. So basically, GDXW will be tracking 1.2x the returns of the GDX. And that GDX is based on the other index, which is the market vector global gold miners index. So uh, the easier way to look at it is basically it is magnifying the performance of the GDX by 20%, like so it is 1.2x GDX. So that's where you see that the fund is using leverage. I'll come to that point now. So what is the structure of the fund? The fund invests in another fund, so that's basically a fund of fund structure. So this fund is investing in VanEck Gold Miners ETF. So the investment strategy is basically to provide returns equal to 1.2x the returns of GDX. So if GDX makes 10% returns, this fund is expected to make around 12% returns. And similarly, if the GDX, you know, provides negative returns, for example, if the gold prices fall, so that will also have an impact, and the fall will also be captured 1.2x times. So basically, which you see here, that's what I mentioned on the screen. The investing strategy, which has leverage, magnifies the returns by 20%. It also magnifies the risk by 20% because you can also get negative returns. So, one small note which I wanted to say, why I prefer investing in this fund compared to GLDW. This is my personal preference, but I can also, look at your strategy and suggest you to look into this aspect. GLW merely captures the gold prices, the fund which I covered before. But GDXW invests in gold mining companies which not only provide exposure to gold, but also gold, silver, other precious metals, plus copper, zinc, and so on and so forth. Because if you see some of the underlying holdings, the mining companies, let's say Rio Tinto or Barrick and so on, they invest in different mining projects which include gold, silver, basic metals, plus various other materials. So you are not just investing in the gold producers, you are also investing in producers of other metals and mining companies. So, with that, I would say that this is a fairly good way to diversify across the metals and materials sector. So, leverage can be a little bit of a double edged sword. It can magnify the returns, it can magnify the risk as well. But if you are someone who is investing for the long term and you have a medium or high risk profile, basically you are willing to take a little bit of risk, then this is a fund which you can look into. Not investment recommendation, just giving you the risk factor. Now, this fund is also a little expensive. When you look at the management expense or expense ratio, it's about 0.99%. And the daily or active tracking of GDX and the leverage makes this a little more expensive. And also, as I said before, the risk and style may not suit conservative investors. Like some conservative investors like what call ETFs, but this one is a little risky. And you can get into this only if you are comfortable and you have seen the performance at least over 1 year. So now let's look at the performance. We saw that the expense is pretty high because of the daily, because of the regular or daily management of the trades and leverage and so on. So far, the fund has been in presence for about 10 months. The fund pays weekly distributions. So bear in mind that is weekly distribution. So we have about 39 weeks worth of data to look at. In terms of price, when I look at the price at inception to now, the price has actually fallen by 31%, 31.4 as you see on the screen. This is over the last 39 weeks. Unfortunately, the fund doesn't have a longer history. They started in October 2025. So this data is for the last 10 months or 39 weeks. And distribution yield, the amount of distribution they did was about 41.5%. So fortunately, they have a high amount of distributions, and due to that, total return comes to 10.1%. So not bad. Like the fund is relatively new, doesn't have a great track record so far, but still it's not bad as such. Like it's still being able to generate high amount of returns, especially on the distribution side. Now, what would be the projected annual return? That is something I'm going to show you. But this projection is merely for educational purposes, not investment recommendation. Keep that in mind. Okay, let me show you how I did that. Excuse me. Now, I have the data of this fund. I'll zoom it for you. So the price 1 year ago was $50 5 cents, October 30, 2025, and now the current price is $34.35. Now, this is something disappointing. Like you see, the price return is pretty less. Distribution is 41.5%, 10.1% is the total return. We saw that in our screen. Now, how do I project the returns for 1 year? Like this is just a guess or an estimate or a projection, whatever you want to call it. Not this is not perfect, and we cannot predict the future, right? So since inception, like the fund has made about 20.77 $20.77 in payouts. That is over 39 weeks. So based on the math, the payout per week will be about 53 cents. 20.77 divided by 39. You can see that on the screen here. So if you're following me, so this is the payout that we have been receiving on an average 53 cents per week for last 39 weeks. Now, what about the next 13 weeks? Like because we are having data up to 39 weeks, if I want to capture the returns for the whole year, I need to estimate for 52 weeks what will be the returns like. So I can do a rough math and divide this by 39 and multiply with 52. I can do that, but instead of that, what I'm trying to do here is I'm trying to take a more slightly moderate or reasonable estimate, because if you see the payouts here on column E, you can see this payout amount paid. Like it's been about 39 cents, 29, 24 cents. It's going up and down every week. So if you see in June, like it has been like 49 cents, like it's been pretty higher, and 47 cents. At one point, it was 20 cents, very low. So it keeps fluctuating, moving up and down. So just to get a reasonable estimate, what I did is I took the recent 12 weeks average. Why I did not take the data before that? Because before that, if you see, you can see in April and all, you got like 63 cents, 73, 79, 69, bigger numbers. So I took the recent one because it has a slightly lower amount of distributions, which is more like a moderate or conservative estimate. So when I took the average, it's about 40 cents for the last 3 months, roughly 12 weeks. And if I take this 40 cents average instead of the 53 cents, I take the 40 cents average for the next 13 weeks. So I'm getting a payout of 5.15. So adding 39 weeks plus the 40 13 weeks, like these two, I'm going to get the full year's estimate. So adding this one, I'm going to add this one. I'm going to put a different color here, put blue color here. Adding this one plus this one, A plus B, I'm going to get this total payout, which is 25.92. So 28.77 for 39 weeks, and the estimated $5.15 for 13 weeks. So adding the two, we have 25.92. So this $5.15 is basically this 40 cents to multiplied by 13 weeks. So whatever it is, you understand the whole idea. Don't worry about the exact math. But now, based on this estimate, my distribution yield is coming to 51.8% for the whole year. Mind you, this is not the yield based on current price. This is based on the price 1 year ago. Like, so imagine that if I invested 1 year ago at $50, and this is the yield that I am getting, like 51.8%. Again, it's too high, and the price return is 31 minus 31. So putting it together, you get 20.4%. Like if you project for the whole year, there are two assumptions I'm making here. One assumption we already discussed about the yield that we are estimating based on the recent 3 months performance replicates over the next couple of months. The other assumption that I'm making here is the price return will also be more or less the same, stable. Assuming the price remains stable at the same level. I mean, this is just an assumption, it could completely change. I could be completely wrong. And based on that, it comes to 20.4%. So this is what I see. The price can go up, price return can go down. Anything can happen. So this is what I see if the current distribution rate continues and the current price stays more or less stable. So this is for the first 1 year that we can expect the performance to be probably close to 20% in total returns. Now, whether it will be exact 20, I don't know. It could be 15%, 20%, probably in that 15 to 20% range is what I think it might land up. But we never know. So let's go back to the video. So we went through the estimate walkthrough. Now, let's understand the pros and cons of the fund. Rather than explaining to you each and every feature, I'm going to cover that in the pros and cons. So you will get a complete idea about how the fund works and how you can, look into this fund, like understand its plus and minus. You see more cons, but that doesn't mean the fund is bad. Like this, I'm just giving you a more balanced picture. Okay, first let's look at the positive aspects. Number one, you get a one ticket exposure to precious metals, miners, and you can say producers of all these metals or mining companies, especially the companies which are involved in extracting and getting these metals from the soil or the earth. So you get one ticket exposure not only to the gold miners but also to the precious metal miners plus also the base metal miners, and you have income potential. That's point number one. The point two is high frequency of income or cash flows that attracts many of the income investors. And for disclosure, I also have exposure to this fund, and it's purely for yeah, exposure to gold or metals plus also the income. The income is pretty attractive, and this helps generate income from a commodity based portfolio. Like, so if I invest in a general gold ETF, I may not get that income flow, but with GDXW, I'm going to get that weekly flow of income, which is pretty good. So that's the great advantage for conservative and income based investors. And for the fourth point, the leverage actually helps enhance your returns and income. Not only enhances your capital appreciation, but it also enhances your income. So that's a great plus point. Last but not the least, this is suitable for investors seeking the precious metal miners as the asset. So in this case, we are investing in the precious metal miners, not the precious metal itself. So not the physical metal. So that's the difference you need to understand. So when I come to the cons, you will understand some of these points pretty clearly. Now the cons part, so I already mentioned the expense ratio is pretty high. So that can be a con. Like if you're looking for lower cost, this fund is probably not for you. And the price return can be volatile, like the underlying being the index uh, provides some stability in this case because you're not investing just in the gold but in a basket of gold mining companies, and there is an index that you're investing in. It's the gold miners index, so that provides some stability. But of course it is pretty volatile, like that's something you need to you know contend with. So depending on your risk profile, you decide like whether you want to go for this or probably other options. And distributions are very variable and highly unpredictable, so that's something you have to live with. If you're looking for a stable amount of distributions, probably you can look at other funds, index funds, or other equity index funds, for example. They could be more stable, but this one is going to be highly variable, goes up and down because the volatility in gold prices can be different, and the premiums that you receive from option writing can be different, and also you don't know the exact performance of these different gold mining companies. uh, One thing that helps you is if you're a long-term investor, you're not looking for that short-term play. This fund is good for you because you're not trying to time the market, you're not trying to make any short-term gains. You want to stay invested longer, so that's perfectly fine. And leverage especially can be risky. When the underlying index goes down, like GDX index falls, then your leverage is going to multiply your returns 1.2x. So the fall can also be multiplied 1.2 times. So as the returns are really good, leverage returns are perfect. Whereas the leverage returns on the negative side can also be a problem. Like so, it's a double-edged sword. And like I already mentioned, this is not suitable for people who are looking for exposure to the precious metal. So it is just the opposite of the pro or the positive point I mentioned. So if you are looking for pure gold or pure silver exposure, look at other funds or other options. GLDW is one option for you if you're looking just for the gold price exposure. And last but not the least, bear in mind that this fund is only 10 months old. So we need to still look at the 1 year mark and assess the performance. I did a walkthrough to just show you, the 1 year potential return, but we never know how the performance will be. And so far, it has been okay or decent, I would say, for a new fund. But if you're looking for investment and you're not started, I would recommend that wait for 1 year and then we can look at the whole data again and review and see how good or bad it is before you invest your hard-earned money. So that's the summary of pros and cons of this fund. It's not perfect. It has a lot of risks, and it is not suitable for someone who is conservative or just starting to invest in this kind of asset class. So this is for someone who is a little more experienced, a little more seasoned, a little more capable of taking that kind of risk or that kind of leverage with your investment. And if you have a medium to long term horizon, this is a fund which you can consider. So if I hope you like this video, and if you liked what you're watching, uh, please share it with people you know. And if you love this video, please give it a hype. And if you have any questions, feedback, or any suggestions for improvement, please drop them in the comment section below. Thank you. Have a nice day.